CIO and founder of IPS Strategic Capital. IPS is a derivatives-based risk management firm, and he teaches practical derivatives-based strategies at the University of Denver. I think what you're going to find is that all three bring a unique perspective to this topic. Looking at their slides and talking to them prior to getting up here, it's quite clear that each takes a very unique approach to the topic that we have today. And with that, I'll turn it over to Tom.
Yeah, risk management. Protective Put does a great job eliminating tail risk because it's a hard hedge. It's an insurance policy. We all know that. I can calculate mathematically if I have $1 million portfolio. The notional value of the puts, let's say I'm trying to hedge the S&P 500. I can say, okay, the S&P is at $1,700, $178,000 divided by the portfolio. I need about 5.5 puts. And I can mathematically define for my client pretty much zero downside risk. It's an insurance policy. It's pretty simple. Problem is, it's very, very expensive. So we don't do it. We time it. We think the market's going down, so we might run in and buy a protective put. The VIX call and the VIX future, these are all exchange-traded opportunities as what I call a hard hedge. Even though the VIX is not really a hard hedge, it's not a mathematically defined instrument because it's a second derivative of the price of the S&P. So bottom line is it's the implied volatility of the implied volatility. So when people go in and buy a lot of protective puts or calls, you would essentially see a rise in this fear index, this VIX index, which I'm sure many people in this room know about and watch and see it on Bloomberg or CNBC every day. But the problem is the heavy cost on a hard hedge. But what if we could eliminate that heavy cost on a hard hedge? That would be your cake eating too. So let's see over the next 10 minutes if I can explain how we could possibly mitigate or eliminate the carry cost on a hard hedge. So let's take a look at a 1 month rolling VIX call. So all we're going to do is buy the front month VIX. We're going to use the call, not the future. We can do this with the future. And we're going to sell it one day before it expires, and then we're going to roll it. What happens is we can see that it is a tremendous opportunity set in 08, flash crash, the European crisis in 2011, but look at the cost of carry when you don't need the hedge. Let's define carry as the cost when you don't need the hedge. So if you don't have a tail event, it can cost your portfolio as much as 6 to 12%. So if I'm going to buy a protected put strategy out the money, I'm going to spend 12% a year to protect tail risk. You wouldn't have clients. They'd all fire you. So you don't do it. Maybe you time it. So that's the problem. It's the heavy carry cost. So let's see if we can use the structure, the normal structure of the VIX to try to eliminate carry. Now, what we're looking at here is just that the VIX is a fear index. So what it really represents is that the future of the VIX, the behavioral side of the market, as Dr. Howard says, is that people think that in the future there's probably going to be more volatility today. So you're going to pay up if you buy a longer term futures, front month, back month, or a call option. You're going to pay more money for going out on the curve. And this creates what we call a contango structure, where the future or the longer term option is more expensive than, let's say, the VIX spot. Now we all know you can't invest in the VIX spot. So you have to invest in VIX option or VIX future. But this term structure creates a negative carry. And that negative carry is the problem. It's a very heavy hard cost. So what do? A lot of products, a lot of advisors might say, well, I'm just going to go farther out on the term structure. I'm not going to deal in the front end of the curve. and that will reduce my carry and give me some type of a hedge, or at least a tail hedge. But the problem with that is that there's a huge tracking error between a longer-term VIX future or VIX option and actually the spot. So you really don't get the hedging you want until you get near expiration. As you can see, as we approach expiration, we start tracking error drops and we get a very high correlation. You can see that also here, where you don't get a lot of response in back months, but as you come towards maturity, you do. Okay, so you're damned if you do and you're damned if you don't. You've got to go out, you've got to go short term to get a good hedge, but if you do go short term, you've got a steep negative carry. So, what can we do? One of the most popular ETNs in the market, and probably a lot of people in this room have used it or know about it, is the VXX. It's the heaviest traded ETN in the market. But you can see that it does a terrible job of really hedging off risk. In fact, 40% of the annual difference is because of this negative roll, this negative carry. Not a very good product, but a very popular. So let's talk about something we might be able to do that will actually eliminate our carry. So if we're trying to eliminate tail risk and we buy calls, let's say on a systematic basis, let's say I buy a 60-month call, let's say off the money every 30 days. And I allocate in my portfolio, I'm constantly buying that call. And that call is normally selling to the spot, so you're losing premium. And that's dragging your alpha, right? That's taking away your upside. Your client's pissed off. Why? Because you're not keeping up. You tell your client, I'm hedging. Well, what happens is, at times, the term structure will steepen. In other words, the market is saying that the futures, there's going to be more fear in the market in the future. So actually, the longer-term future, the longer-term options become more expensive relative to the spot. The basis increases, and we continue to buy that call. But what if we get a steepening of the basis so that when the basis is steep enough, we can actually also buy a put? Now, for anybody that doesn't know, if I'm buying a put, let's say the futures contract, the 3-month futures at 28, and the spot today is at the spot's at 13. Let's say the spot's at 15. If that put settles to the spot, guess what? I have intrinsic value. I just made money on that put minus the premium. Well, this is exciting because what this can do, this can offset the call of your tail risk hedge on a systematic basis. You buy the call, you buy the call, you buy the call, and then we got a steepening in the term structure, we buy also the put. That settles to the spot. I just paid for my calls. What's nice about this strategy, when you run a detailed empirical regression analysis of backtesting on this strategy, what do we find? We find that when the call is needed, it has a very good beta response. And that's what's great about the betas. That you can get 7 to 10 times beta, so you don't have to put a lot of money in that fixed call. And in 08, you can see the yellow line represents a tremendous explosion in that, going from a contango to a backwardation situation. But when you don't need the insurance, when you have a market like you have today, look what happens. The blue represents when the puts pay off. Now, this is very, very exciting, ladies and gentlemen, because even when the put doesn't pay off, only 55% of the premium is lost on the put because the puts don't expire worthless. They still have intrinsic value. So if I put $10,000 into the put, I might get back 8. I'm losing 2. This is exciting because what we've done here is we've got our cake and eat it. As financial people, we can actually create a hard hedge opportunity with essentially a negative to a neutral carry. Now this is a detailed regression analysis showing that we're getting the response when we need it, but when we don't need it, it's not a hard cost of the portfolio. This is a beautiful, beautiful strategy. Now, if I just take this strategy, which is essentially called the VIX calendar strangle strategy, and I put it in a 60-40 mix, which is the most popular mix, as we all know. And I just allocate 3%. In fact, if I just allocate 25 basis points a month, look what I do to my P&L over the last 7 years. I drastically reduce my annualized return because I really mitigate my drawdown. Why? Because on a 60-40 mix, you have about a 31% drawdown at 0.8. And not only that, because of my neutral to positive carry, I'm able to really outperform. So what does that mean to you? What does that mean to your clients? That means over a 6-year period, $1 million portfolio is worth about $1.6 million as opposed to $1.2 million. And what did you do? You allocated 25 basis points to a strategy that, guess what? When empirical data tells us it's not costing you any money. It's really your cake and eat it. It's a home run. What's nice about this strategy, it's repeatable, it's systematic, it's definable, it's objective. What's nice about this strategy is all you need is level 1 approval for your clients. You're not selling any options here, ladies and gentlemen. You're buying calls systematically, and when the term structure's even, you're buying that put to pay for the systematic call. You eliminate that tail problem. What would that mean to your clients? To say, hey, yes, and this allows you to be more aggressive. And right now, if you're in a 60-40 mix, what did you experience last month? The S&P was down 1.5. Guess what? Your bonds actually did worse than the market. So you got a lot of debt risk here. So if I can hedge off my debt risk, and I can try to get my client more alpha, but then I can feel very comfortable about a deep hedge strategy, it really is a beautiful thing. And it does work. And the data supports that. Simple. Everybody in this room should take a hard look at those. Feel free to email my office. I'd be more than happy, my team, to email back and explain the details of the strategy. But this is how we eliminate tail risk. We do it very efficient, cost effective.